Thank you so much for staying with us here on the Property Show. And of course, starting today, we are going region-wise to different geographies to make sure that we take or we look at property in clusters. So coming up next is, of course, North India, specifically National Capital Region with Greater Noida and Gurgaon. So stay tuned, keep watching. Meanwhile, another very, very interesting report that we're going to discuss. Several experts have been maintaining on the show that commercial or office space is something that retail investors should definitely keep away from. But after seeing the latest report from Knight Frank India on the top 10 business districts of the country, what returns could you potentially earn from them in the next 4 years? I'm inclined to revisit and explore if the risk-return ratio in office space real estate could actually be a favorable one. So let me quickly summarize the key takeaways of the report before I bring in Ghulam Zia and other experts also on the show in terms of what's going on. Alright, so let's first look at the calculation of investor returns. Investor return has been calculated on the basis of recurring rental income and capital gains during 2013 and 17, so 5-year period. Rental income is net of property tax and interest payment on debt amount. Now, assumptions for the calculations, let's take that because it's really important for you to understand how these figures have come up. There's investment period of 5 years, we said that. There's also debt equity ratio of 1:1, interest cost of 13% per annum. Let's bring in now the top 10 business district as per this report. Well, let's start with Mumbai. It tops the chart with Central Mumbai, Parel, Lower Parel, Dadar, Prabhadevi. Returns per annum, and we're talking about capital appreciation and rental yields is 19% in the 5 years, and these are per annum returns. Mumbai secondary business district West, Andheri, Jogeshwari, Goregaon and Malad comes next at 15%. Hyderabad comes third at secondary business district, which is High-Tech City, Kondapur, Madhapura, Manikonda, Kukatpalli 14%. Mumbai again another market which is BKC, off BKC, Bandra, Kalina, Kalina Nagar is also at 14%. Okay, wow, these figures are looking really exciting. In fact, if you look at some of them and you go down the list, this list will keep flashing. There's Pune, there's Chennai, there's another Hyderabad market, and of course Chennai again, which is SBD, Mount Punamali Road, Porur, Gindi, Nandanam at 13%. So pretty much we are ending the top 10 business districts between a range of 19 and 13%. So Ghulam Zia, Executive Director, Advisory Retail, joining us from the Mumbai studio, and here Om Chaudhry, Founder and CEO, Fire Capital Fund, giving us a perspective on whether he would put his money behind commercial and office space or not. So Ghulam, just run us through the basis. You know, the 19%, I know it's only one market which is giving you this kind of return, but I was surprised. Really, Mumbai, I thought office space was going through the dumps.
Well, you are right. In fact, these findings actually came as quite a shocker to us as well. However, let me answer that slightly later on. You asked me, how have we done this whole calculation? Well, we have to obviously start with understanding the demand in the market, and that's exactly what we did, forecasting the demand coming from various sectors of economy. So we have gone down the service sector, whether it is IT, ITS or the rest. We have gone down the sectors of pharmaceuticals, the FIs, FIIs, the insurance, etc. And in all of these industries, we have actually calculated the kind of manpower requirement and accordingly what kind of office space that these sectors would require in times to come. And we superimpose this whole thing with what is it that the developers are going to bring in the market, and then we have a demand supply kind of a gap coming up in front of us, and accordingly then we have taken up the whole concept of how the price will grow based on demand supply mismatches, etc. And obviously that going down the road have we come to this numbers. And that's when we have this entire ranking in front of us, taking into account, as you explained earlier, all those capital expenses as well as your recurring expenses of property taxes, maintenance, the monthly outgoings, etc. Keeping all those things in mind, this is what we have come to. Let me also tell you one thing, that these returns don't take into account the income tax. That's the only thing which is outside the purview of our finding, because these income tax also, the numbers can be adjusted against individual earnings. So when we spoke about the interest on the debt that one is taking, that benefit also will come back on your returns while you're talking about income tax, etc. So in a nutshell, this is where it is, the ranking you're talking about. Now talking about why lower parallel and why even we were very surprised to look at it. Let's look at it this way. Lower parallel in last couple of years has gone through a very bad time. Why has that happened? It's purely because huge amount of supply came in, infrastructure was crumbling, and the demand was actually very bad. But in the meanwhile, we had a couple of these developers, right from India Bulls to Peninsula, etc., who actually came out with very aggressive pricing strategy, and they have maintained a lead in this entire absorption of Mumbai. They have got people from Nariman Point, from BKC, from all over Mumbai to seriously look at lower parallel, because at that price, even that pinching infrastructure can also be taken into consideration, and you can look into or move into this locality. So slowly we have come to a situation where lower parallel is as good as almost absorbed. The vacancies are pretty low. And with this, going forward, there are times when you will see the rental income in lower parallel also inching up. At the same time, the pricing, the capital pricing also, we have anticipated, we have worked out, we have analyzed that even capital prices have moved on, are going to move up. So in a nutshell, with both these aspects going up tremendously, we are going to see the kind of return that we are projecting, which is about 19% from lower parallel.
My goodness, I just hope it happens, Ghulam, because right now that market is looking so much under pressure. That's music to the ears of at least everybody who has office space in that market. Okay, so let's move on to the other market of Mumbai that you spoke about, which ranked actually number 2 when we're talking about Andheri, Jogeshwari, Goregaon and Malhar. But before I come to it, BKC doesn't feature or it features at least much lower down at only 14% returns. Is that simply because BKC has become very expensive and very quickly, and that's the reason why it's going to be more muted going forward from here?
Absolutely, that is the point. If I have to talk about an entry level or an entry point into investing into any of these markets, look at it this way. If I spoke about lower parallel, obviously because the price were absolutely in dumps. So today if any investor walks in, obviously there is no sweat on this. Times to come, property prices will go up, rentals will move up, etc. Same is the case with even the western suburban market of Mumbai office markets. Even there, those Andheri, Jogeshwari, Goregaon areas are where really top class office developments are coming up. And in terms of demand, let's accept it, all your Standard Chartered, etc. don't mind going to these locations today. There's a separate Standard Chartered building in Jogeshwari. So the point I'm making is that these are the markets where prices are currently depressed, and going forward you are not going to see any further correction in these localities. So what we're talking about is good upside available here. In a stark contrast, a BKC, which is as it is on pretty high prices. So if you're talking about a 250 to 350 kind of lease rental that you would expect in BKC, it's pretty high, pretty steeply priced. So if you compare say a BKC to a lower parallel, it's practically half the price point, or whether Andheri Kurla, even lesser than half. So what we're talking about is BKC actually notching up so much or going up so high that today if I enter in this market at that price point, then for me to expect returns, it's going to be really very difficult for the market to reach those levels for me to show any return.
Okay, so Mumbai decoded, understood. Let's understand the other 3 markets, which actually cities which make into your top list. I don't see Bangalore here. I see, interestingly, Hyderabad making the 14% cut, and high-tech city, Kondapur, Madhapura, then there's Pune as well, and there's Chennai. So out of this, if your premise is that the markets which have been depressed and underpriced and therefore they will see an appreciation, Hyderabad definitely comes up right in front, both in infrastructure and availability of office space and the fact it's available cheap. What's working for Chennai? It's an expensive market. Everything that you've listed out here is very expensive.
Well, see, the expensive, and even when talking about Chennai and talking about the cost part of it, it still is not as expensive. Because the stretch on OMR that we are talking about is really the prime location of OMR, which is before the toll, crossing the toll at Perangudi. And this is the junction where you have all those tidal parks, S&Rs, RMGs, Chapoji, Palanjis, etc. The real classy buildings and proximity to the city is fabulous. And also the metros, etc. that are shaping up and shaping up fast are really adding tremendous value add to this locality. So the price point with infrastructure taken into consideration still looking lucrative. And mind you, we are, while talking about Chennai, it's obviously not the top 3-4 locations that are still finding, that 14-15% return. In our opinion, while it's a decent return, but it also depends a lot about an investor appetite. So the people in Chennai would obviously won't mind investing into Chennai. But if you ask me a question, if an investor from Mumbai will go out and invest in Chennai, I doubt. And that's why, this has to be seen in right perspective. The report that we are talking about is giving you the whole return perspective of the top 25-30 CBDs of the city, of the country. But at the same time, the investor perspective has to be kept in mind. So from a Chennai perspective, it's a good return. And ultimately, if the investor return as a number which is going to be the final number, then it's in front of us. 19%, the only one market which is Lower Parel which is going to give you that. Otherwise, the rest of the markets are in 13 to 15%. And remaining, in fact, most of Delhi and NCR markets are way below. So we're talking about 12, 13% or 11% return, which doesn't really make sense for an investor to actually go to these localities and invest today. So what we have tried to do is put up the entire canvas in front of you. An investor has to decide what is right opportunity for him or her and invest accordingly, whether it's his own city market or somebody who is sitting in Chennai would want to come and invest in Lower Parel. That's possibly an option available to you.
All right, fair enough, Ghulam. So I'm going to come to you, Om, and figure out, most of the experts who've come on the show have said office space is not the way that I'd like to go. In fact, we've heard of developers not moving away from developing new office space and converting those land parcels initially meant for it into residential. Is this then what Ghulam is saying, that the fact that supply pipeline is going to now start drying up, and essentially then you will start seeing both a firming up of rental and capital values?
Yeah, in some sense, what this report does is a little of that, looking into the future. The pendulum is now going to swing back at some point. Now, what point in time is the real question. You're right, and more so, 6, maybe a year back, there was a much stronger feeling that commercial is not, whether it's an institutional investor or a retail investor, residential was more preferred and commercial office space was kind of down in the dumps. But if you look ahead, there has to be some turnaround that will happen because you cannot have residential continuously going up in the absence of a strong commercial and office space pipeline building up and doing really well, and that's what would kind of create more office demand, residential demand.
Do you think now PE investors who'd almost given up actually, other than Blackstone, which has been aggressively looking at either SEZs or large parks, technology parks, etc. investments, most PE investors have actually moved to the residential side. When do you think PE money will start coming back to office?
I think PE money is already in stealth mode, looking at very attractively priced office investments already, have been for quite a while now. It's just that when they were looking for really good value, they weren't kind of seeing what they were looking for. A lot of these projections are what kind of demand supply situation we will see in the years ahead, the next 4 to 5 years, and what kind of capital appreciations we will see in these various micro markets. So what you're basically betting on is the future, and what kind of whether it's capital appreciation or the certainty of rental incomes with some kind of appreciation kicking in.
The split we haven't showed because that would have just cluttered the screen a lot, but it's pretty much capital appreciation.
Yes.
If you look at that 19% return that you're getting from Lower Parel, there is a large rental component, but rental is still below the double-digit figure. It's much lower than that, Sameer, and
that's exactly the point.
I would agree partially with this report because if you went 5 years back to Lower Parel, commercial was 30,000 rupees a square feet and residential was 18,000 rupees a square feet.
And now it's flipped?
Today it's completely flipped. Right? So the commercial has to catch up because it does give you that 12% annualized yield at current values. So when market starts to pick up and good assets today are trading at 9 to 10% yield. So there is a high probability of commercial assets further increasing in terms of appreciation. But with respect to PE money, I think they're only looking at ready assets because they don't want to take chances. So absolutely. So there's a huge.
And now at the current prices, if we go by the report, they are lucrative.
But the developers may not want to exit at those prices because they have leased these places out at rock bottom. Maybe they won't even break even because they bought these places at much higher FSIs. Sure. India Bulls, for example, the cost of FSI may be 18,000 rupees a square feet for all I know. So I would say that price appreciation, yes. PE funds looking at only ready buildings, but PE money in under construction commercial projects is not going to come in the short term because nobody wants to take risks. Nobody wants to take risk with investing hundreds of $millions in building 500,000 square feet and then that asset remaining empty.
In fact, BKC is happening. It's becoming a struggle. Some of the spaces which were built for IT companies or as ITES are now beginning to get leased out to all and sundry. They don't have the component of tenants is not really IT. Ghulam, just one last question. What happened to Bengaluru? If I look at the figures from other reports, it seems that office space absorption actually has been healthy all of 2012 in only one city, which is Bengaluru. But here, when I look at the returns parameter over the next 5 years, Bengaluru is still quite muted at 12%.
Well, Bengaluru as a market, as we call it, is the most stabilized market of India. So even if you talk about a residential asset class, this is one market which has remained in the same price point for a long time. Price points have been moving between 2,500 to 5,000 rupees in Bengaluru for years that I can recollect. Same is the case with office market. This, mind you, is a market which is driven by ITES. And ITES, especially the ITES part or the back office jobs, which is the major chunk of occupier of office space in Bangalore, has that $1 mindset. The 40-50 rupees a square feet rental is the break point beyond which everything comes to a standstill. So this is one market which has remained very, very stable. There are no currents up or down, no trends, nothing. So in that case, if I'm talking about a pure investor perspective, from an investor perspective, I have to look at markets which will give me a very opportune time to walk in and a very good time to exit. No, such times don't exist because these markets are very, very flattish. So because of that, Bangalore with that moderate 12-13% return, most markets are playing in that region. So what it means simply is that your returns are essentially your rental returns alone. When I'm talking about 12%, which is 11-12% cap rate or yield, annual rent yield that you're talking about, that's it. Property price appreciation is very low and hence it is not building up to your investment return overall. Very minuscule. So 12-13% are as good as actually getting your rental return alone.
Absolutely. So Bengaluru isn't making the cut. In fact, if you take that as rental return should be at least 10 in double digits, then not too many markets would even here just about make the cut. That brings me to another question. Okay, so it might be just Lower Parel, which is and another market which is Andheri, Jogeshwari, etc. Two markets, 15 and 19%. But irrespective of that, any large investor, I wouldn't even go down to someone who has a crore or 2-3 crores. But I'm talking about HNIs here. Do you think they should start looking at these two markets in Mumbai?
Yeah, they should, and I wouldn't kind of talk specifically about these markets and the others which have been talked about in the report, but at a macro level, the comment that I would make is that for HNI investors looking, they should start looking, and what they have to keep in mind is the fact that, like I was saying earlier, there will be a point that you think now it's kind of bottomed out and it's going to pick up from this point onwards. But what you have to keep in mind though is that there is a lot of suburban, high quality suburban office space which is either just getting ready or has the potential to come up very quickly because a lot of projects have kind of been stalled.
In fact,
so when that happens,
13-14 will continue to be an oversupply situation. It's only in 2015 that you'll probably begin to see a match, and then
things might start looking up. So what I would do as an investor is be on the lookout. I wouldn't now be in a mindset where I would say that, commercial is not for me. I would start looking, because it could be a 6 to 9 month horizon that a smart investor always has. And
Sure.
good real estate investing is about the future and not the present. And that's where a lot of these capital appreciation numbers that have been kind of factored in, that's what you have to be smart about.
All right, we've spent a lot of time, but it was a really interesting topic. Ghulam, thank you very much for bringing to us this report, and hopefully next time we'll get an exclusive break on the channel before it becomes public. I'm taking that from you as a promise. All right, and of course, always interesting to have your perspectives. Sameer finally agreeing, saying Lower Parel office space looking very interestingly priced. So that's all three of our experts saying it's good time to start looking at some of those markets for office space, especially the one that top in this list. We'll be back, and we will go back to residential smart home investments or options in Bangalore, and again Hyderabad, another city which is climbing up the charts in our list.